Hi everyone, welcome back. Today we are going to discuss about a very important topic which is going to be very useful for all of us. And so please don't skip the video, and it's you have to watch till the end to understand the complete picture. And this may be a lengthy video. Maybe probably I will make it in different part one, part two like that. But try to watch whenever you get time. Try to watch the complete video so that we will get a clear understanding about what's happening, what is the recession fear is all about across the globe. What is about like inflation, interest rate they are increasing in the US. So why all these things are happening and what next in the stock market we can expect, right? So we are going to discuss about all these topics, and I request you to watch till the end. Okay. So with that note, we are going to start. Let's see what are the different topics we are going to cover in this video, our video series. So first thing, what is inflation, which we already know, and so the recession topic, which I think now everyone started talking about, recession is going to come in US especially, and how it is going to impact our country, India. So there are a lot of discussions going on from different corners of the world. So what is about the recession situation, and US bond and the yield curve inversion. So what is that yield curve inversion? So you would have heard about this already, but let's discuss here. I will try to cover in detail, and what are the different market cycle and why that is important to discuss now, and what are the different sectors we need to focus now, because in every market cycle different sectors perform and during recession there are certain sectors which performs compared to the other sectors. So we need to understand this market cycle and what are the different sectors we need to focus to continue our investment in this market situation. And these are all on the different global perspective and how do we need to position ourselves. And we are going to see on the technical side as well, technically how we are structured, whether we need to really worry about all these recessions, how it is, how the charts are teaching us, showing us, right? So that we are going to see in the last part, and I will try to cover in all these topics, but it may be in different series. Okay, so with this, we are going to start first on the inflation and what is the recession we are talking about, right? So inflation, which everyone knows. So in the US economy, we see record high inflation, right? So let me start with this article. There is one article which we need to go through. So especially this point, is the US headed for a recession? So let me read out, and then each and every keywords here we need to understand in detail. So let me explain in detail. Before that, we will start with this paragraph. We will read about this. Opinion is divided on the question, with many economists warning of a recession and Wall Street bulls saying those fears are overblown. Right. So the familiar precursors of a recession have arrived. So there is so this statement, right? So there are few parameters, there are few key metrics which tells in advance that the recession might come anytime in the near future. It may be in months or years, but there may be a strong correlation between these metrics and the recession, which happened in the past. So what are those? First thing is the inverted yield curve, which we are going to see in detail, and then the important point, right? Rising interest rate on the back of high inflation, which is what the current situation in US. In US, it is 8.5% in the month of March, which is the highest inflation in last 40 years. So a country like US, which is developed country, is having high inflation than the countries like India. Like we are developing countries, but our inflation is much lower than the US inflation. So that is something very serious about, and that's where that Fed chairman Powell, they came back on the interest rate hikes, right? So they started giving the warning for last 6 months, and continuously they are increasing the interest rates. So that is the sign, that is a metric before recession starts. So we are going to see all these things in detail, right? Along with this, there is the COVID uncertainty happened, and then the Russia Ukraine war happened, and unemployment is increasing in US unemployment data. So all these things are signs of recession. That is what the history tells. So let's first understand what is this inverted yield curve, right? So let's understand about this. So before going to this yield curve chart, so I will just explain about that. So let's see, like, what is the, first of all, what is the US bond, right? So US, any government, right, if they want to do, if they want money for their plans, whatever they want to execute, they need more money. So they come and issue bonds. So they collect the money from the people from different organizations. So they release bonds and they collect the money for their expenditures. So those are the bonds, US bond, which we would have heard about, right? So there we have different bonds. 2-year bond, let's say, like 2 years bond, 3 years, 5 years, 10 years, 20 years, like that we have different bonds, right? And we know, like, the short term bonds, maybe we will talk, we will discuss like short term yield, right? US bond yield, the yield will be lower when compared to the longer period, right? So it will be like, for example, the chart, if you think from a chart perspective, it will be something like this, right? The 2-year bond will give less return than the 3-year bond. So the yield will be lesser for, this is the yield. This axis is the yield. And this is the number of years. So this is 2 years bond, 3-year bond, 5 years bond, 10-year, 20-year, and 30-year bond. So 2 years, which is the short term bond, will give less return, less yield, and 3-year will give higher return. 5 years will give even higher. 10 years, 20 years, and 30 years. So usually this is how the bond structure, the bond yield will be, right? So, but what's happening now is the yield for the short term is higher than the long term. So the chart is something like this. The short term yield is giving higher return. The short term is giving higher return and the long term is giving comparatively equal or less return. So let me take you to this one of the book called Intermarket Analysis. So in this, it is explained in detail. Like, this is the 2000 dot-com bubble event, recession started. Before that, this yield curve inversion happened. So anyway, this will discuss in detail again. Just focus on this yield curve inversion, the concept, right? So there was a lot of talk in the media this week about inversion of the yield curve. They kept describing the market action versus as confusing. We don't agree. Here is how it works. In the late stages of an economic expansion, early signs of inflation begin to crop up, usually in the form of rising commodity price that puts upward pressure on bond yields, right? So at some point, Fed starts to raise interest rates. So this is what happens now, what's happening now, right? To slow down the economy. That causes short-term rates to rise faster than the long-term rates. So this is what happening here. Short-term, I deleted drawings. I will show in this chart. So this is the yield curve inversion, right? So the short term, like 3 months, 1 year, 2-year bond, 5-year bond is giving higher return than the 30-year yield. So this is what happening in the market currently. The short term bond is giving higher return than the long term bonds. So why this will happen, right? That is because so in this we can see so that causes short-term rate high faster than the long-term. The danger point arises when short-term rates move along with long-term, so which happened in the past week while inverted curve. So why this will happen? In the past, inverted yield curves have usually marked in the end of economic expansion and the end of bull markets in the stocks. So this usually happens when there is a bull market end, in the final phase of the bull market. This usually happens because there is uncertainty. The public, the people, right, they are scared about the uncertainty in the economic condition. So they go for short-term bonds and then the yield for the short term increases. So this is one of the key metric before any recession happened. So how do we back test this, right? Whatever this yield curve inversion, whatever we are talking about, whether this happened in the past. Yes, so that's what we are going to see in the next session. Okay, so this is 10-year yield. So I have opened the 10-year government bond yield. This is not 10-year bond rate, the bond yield chart, where we can see the 10-year yield is 3 point something. It is hovering around 3.3%, and this is the 2-year yield. We can see how the 2-year bond spiked. It was very less. The yield was in 0.183, 0.2. So that was the range. And from last September October time frame, you can see it started spiking, and we are almost, or it is more than the 10-year bond yield, right? So here it is 3.09, and here it is 3.09. So almost it is the short term yield, which is the 2-year yield, is giving equivalent to 10-year yield, right? So this is, and it was overtaking, like it was higher than the 2-year bond yield, was more than 10-year bond yield at some point of time. So this is the inversion which they are talking about, right? So this is the first key metric before any recession. This used to happen. How? Let us see. Now I'm going to show you one very important chart. Please pay attention here. This is very important. So whatever I showed you now is 2-year bond yield chart and 10-year bond yield chart, and how that 2-year bond yield chart right spiked, and it's giving more return than the short term is giving more return than the long term bond yield. That is called inversion, right? Which I was explaining. But this particular chart, this is very important. This is the chart which can give you in advance that the recession might happen. There may be a collapse in economic condition, and this chart gives very clearly in advance. So let me explain in detail. This is one chart. This is the 10-year yield minus 2-year yield chart. I took this chart, 10-year yield minus 2-year yield, and I have highlighted here. There are the circled one. So let's say this is 2000, right? Before 2000 crash, this 10-year yield minus 2-year yield chart went down, went in this zone. So this is a, let's say like this is the support zone. Whenever it was in this support zone or below this support zone, in the next few years or in the same year, recession started. So 2000, we can see here, we can see in 2000 this happened, this yield curve inversion, right? It happened, and immediately next year we know like dot-com bubble crash happened. And this example, before 2008, the Lehman Brothers collapse. So let me take this Nifty chart. So I mean Nifty monthly chart. So 2008, we saw this crash. So we corrected almost 60%. 60% market fell down. And during this time, like end of December 2007, we were in the peak. And 2007, we were here. Sorry. 2006, August or early 2007, the yield inversion happened, right? This is the inversion chart, like 10-year minus 2-year. It ideally should be on the top, because 10-year yield should give higher return than the 2-year yield. So it should be on the higher end, but it was at the lower end, which means both the inversion happened, right? Which I was explaining. And it gave this early sign. In 2006 itself, we got the sign that it's in the support zone, and immediately it started rising, and we saw a big fall. And one more scenario. So before COVID, so this inversion again happened. We can see it around the same level it reached in 2019. And 2020, we know what happened. 2020, this coronavirus COVID pandemic happened, and we saw a big crash. Now what is happening in this chart, right? This is very important here. Right now we are in April 22. June 22, in this range we are roaming around, and that is one of the primary factor. All these economists from different corners of the world, they are worried about this inversion, this yield curve inversion. That is what this topic, this particular keyword, inverted yield curve. So this is again after this so many, whenever we saw crash, before that this inversion, this chart we can see it clearly indicated that there is a recession going to come in the upcoming months or years, right? So this happened in last multiple times, starting from 1990 crash, and then 2000. This is on the 2008 8 crash. Before that also, COVID pandemic, and now we are again in the same range. So that is the first key metric. Okay. Now coming to the second important point, which is the inflation, which we anyway all of us know that there is a very high inflation going on in the US, and it's historic high, like eight in the last 40 years. It is this is the highest interest rate, inflation rate, right? So 8.5%, which they recorded in the month of March. As a result, the Fed, right? The Fed started increasing the interest rates quite aggressively, and they had like hawkish comment that they are going to focus on, they are going to bring it back to the normal range, and they are going to continue this interest rate increase in the upcoming review meetings as well. So this is what they told in the last Fed announcement, right? So this is known parameter, but this one in inverted yield curve, many people might not be aware. Okay, so so we saw both these points, inverted yield curve, which we saw in this chart before every crash, starting from 89, at least from the 2000 bubble burst, and the different crisis, whatever we saw, the major crash, whatever happened, we related with Nifty. So this is in 2000, and we saw in 2000 there was a big crash from here 2000. After this inversion happened, when this is around 2000, and we saw there was a big crash, and in 2007 we topped out. 2008 there was a crash, and 2008 we were in the same range, the US 10-year minus 2-year bond, which is the inversion, yield curve inversion. And again 2019, it clearly again it showed in advance, and then we saw in 2020 we saw the crash, and now we are again in the same range. So that is one clear evidence. And then the rising interest rate on the high inflation, which is again one key metric. So these two are the with additionally there are some other things like unemployment data. So all these things are the like reasons for the recession that they are expecting in 2020, end of 2020 or early 2023. So it might happen, it might or might not happen, we don't know. But these parameters, whatever we saw here, it gives some signs of recession. Okay, so we spoke about, we saw about this inflation, recession, what are the different bond yields we have, how the yield curve inversion happens, and in the past how it happened in the at the beginning itself, before the recession happened, how this indicator was working fine, right? So we saw multiple cases in different years before recession, how this yield curve inversion happened. Right now, let's understand about this market cycle. Before going to this next topic about market cycle, which sector we need to focus, I request you to give your comments. How do you feel about this content? Is it really helpful? Are you able to understand whatever bit about knowledge I'm sharing? Is it helpful for you? And give your comments, and then please press the like button. I'm putting a lot of effort for this. So let's continue. So market cycle. So typical, this is how the usual market cycle we know, right? So it starts from optimism, the positiveness, and then we get excitement, thrill, and then the euphoria stage where the peak of the market, right? So we trade at the top of the market, on the lifetime highs usually happens here, right? And then slowly it starts falling down, anxiety, denial, fear, depression, and then the panic sell happens. And many people by this stage, many people would have moved out of share market, right? They completely lost, or they lost the patience, money, and then hopefulness, right? Or hopelessness, sorry. And then it again recovers. So when the market recovers slowly, it will take this. This is called accumulation phase, right? This is distribution phase. So this phase is the distribution phase, and this is the accumulation phase. So all these FIIs will be buying lot and lot of shares. They will be dumping the money in this phase only, where most of our retail investors will be moving out of market due to patience. They don't have patience. They lost complete confidence on market. So this is the different stages or different emotions or market cycle we know, right? And then it repeats, starts from optimism, then euphoria, then the hopelessness, the panic. Again, it slowly it recovers. Then again, the optimism stage will come. So this is the cycle. And right now, we are almost near in this area, like fear or depression. In this stage, we are currently, right? And as in the previous session, we talked about the recession might or might not happen, as that is different topic. But the indicators shows that we might soon get recession, right? And we are in this stage. So this is, so that's why this is the right time for investment, right? So this is a stage where all these FIAs will slowly come into our market, and then they will start investing their money, and that is when exactly we will be moving out of the market, right? So that's why I'm bringing this particular topic, that market cycle. We need to understand this very clearly. So we should, many people will be in this stage. They'll be happily investing when the market is rallying, and once it starts declining, they will have all these negative thoughts, and they will be thinking that that's it, and it will take years. So let it take years, but the point is, it for sure it might take years. It might be like it may not be like recovering from here. It may recover like immediately, right? So let me show the chart. So we are here. So we are in this range. So in the technical view, I will discuss about in a detailed technical view what is the long-term view on this on our market. But as a quick review, right? So we may be like further it might fall. So I don't disagree on that, but there will be a recovery phase, right? So we should not move out of investment. So that's a all point. That's what I'm trying to bring the topic, right? So we are in this cycle, we are in this phase, and we should start putting money into this no, buying good stocks, good fundamental good stocks, and in SIP method, right? So don't put all your money at one go. So we need to do like in every fall, every 500 points dip, we might like put like 5%, 10% of our overall capital, right? And that money should be something like you are not going to touch for another 5 years, 3 to 5 years at least. So only that money you need to put it in like multiple investments, multiple and we have to divide that money in multiple terms, and then we need to invest, right? So this is the phase. I think this is the phase where we are currently, and we will definitely see recovery, right? In few years, like I'm not saying in months even, because the recession might or might not again happen, maybe in the end of 22 or next year, end of 2023, we don't know. But there will be a phase where it will recover for sure, and we are in this stage, right? It might take like 1 or 2 years from now, but we need to make use of this stage, and this is what going to be like a golden chance for us to get big rewards in the future. In after 2 3 years or 5 years, it's going to reward very well. Okay, and now coming to the next topic, which is the sector rotation, right? So which sector to focus now, because we are expecting recession might happen in near future, in months or years it might happen, and there are multiple parameters indicating that recession is going to happen. It may be a mild recession, or it may be a strong, so we don't know how it is going to happen, but there are some indicators, early signs we see. And what kind of sectors, right, we need to focus now for our investment. So we cannot completely stay away from stock market, right? So we need to continue our investment, but at the same time we need to no few factors that which sector we need to avoid and which sector we need to focus. So I'm referring again the same market analysis PDF, which is a very good book. I'm also reading through this. So here it is mentioned about the different rotation, right? Sector rotation in different market cycle, economic cycle, and here we can see. So there are different stages we can see here, right? Early expansion, middle expansion, late expansion, which means this is on the bull run time. During that phase, how the sector performs, right? Usually, so this is in the lower side, right? Like accumulation phase. Initially, it starts with the sector. The first sector to perform would be transportation, and then the IT sectors, IT services. Then slowly it moves towards energy. So during the final, the peak level of the market, right? So that is when the energy sectors will be top performer, right? How do we know where, right now? Let's see how energy sector is performing, right? To make us understand very clear whether this is really happening, let's cross check, right? So energy sector would be the last sector to perform well, and during the early contraction period, when the fall starts, right, when the crash starts, it's the consumer staples, those kind of sectors like consumer staples, utilities, those are the top performers will be. So let's first check how the energy sector was performing, right? So let me go to energy. We can see here Nifty was continuously in the consolidation or downside for last since October last year onwards. But look at energy, it was continuously moving higher, right? Only last 2 months it started falling because the early signs of recession, maybe that's why it started going down. And let's see, like consumer, is it doing better? Yes, we can see, right? So when Nifty is underperforming and energy was performing better than Nifty, better than other sectors, and now started falling, which we can relate here, right? So energy was the top, will be the top performer during late expansion and early contraction. During the early, we can say like the sell-off or bear trend, whatever we can call, right? So early contraction period, consumer staples, the FMCG sectors, right? That used to perform better than other sectors. That is very clearly, we can see here, FMG sectors started performing. We can see for last 4 months, 3-4 months, it started moving higher. So which is again giving very clear signal that the indicator, one more indicator gives a signal that this is working fine. So this sector rotation during early contraction, this performs, then it means that there are more pain, right? So this is proving again. So the sector to focus as per this. So it's not something I found. This is there in the book. So and we can study, we can do a lot of research on this. So you can, if you're interested, go and read about all these sector rotation and different market cycle, and we can see this in multiple forums, right? So this is happening, this is working fine, right? We can see it is very evident, right? So the sectors which we need to focus right now should be consumer staples, utilities, and then finance, right? Financials. Why financial? Because we know, like, the interest rate, they are going to keep increasing. So obviously the banks is going to perform in few quarters. It may not be like immediately, but in few quarters down the line, we will see like better results from better quarterly results from all the banks. So as per this cycle, starting from FMCG is one sector, right? So which is like a growth stocks, right? There are two divisions, right? Growth stock. So I will make a separate video on that. So this is during the recession, this is one sector which will perform better than the other sectors. And then the financials, right? So financial, because all the banks and other financial institutes, they are going to get benefit out of this increase in rates, right? So then the consumer cyclical, then again it will start, like transportation, technology, like this. So it should not become like we are completely closing all the selling all the other sector stocks and dumping all our money into this consumer staples. Like a few stocks we can discuss. Maybe I'll do one more video to talk about a few stocks which I have already made investment in last few weeks on the consumer staples sector. I will make a separate video. So we should not, but the point is we should not dump the complete like 80%, 90% like that in this sector. It should be balanced. We should, I have my stocks in all these sectors as well, but I'm planning to offload most of the stocks from here and then add more into this sector, these 3 4 sectors slowly. So I will be having more weightage on these two and financial sectors. Slowly I will reduce from here, and then after the cycle ends, I will rotate, right? My stocks I will rotate into other sectors. That's how I'm planning. So I will make a detailed video again. Let me know in the comment box if you want what are the different stocks I'm investing and continue. I will continue investing. So if you are interested, you can let me know in the comment box. I will make a separate video. With this, I will close the first part of this series, and on the technical side, how it is going to be. So all those things I will try to cover in the next part soon. So let me know in the comment box how this video is it helpful for you? Are you getting something out of this video? Please let me know in the comment box, and if you like the content, hit the like button and subscribe to our channel. Thank you.